So if you want to grow entrepreneurship in a country, you must have private equity. That's why it is so important. In the case of India alone, in the last 10 years, something of the magnitude of $50 billion of private equity has been invested in over 3,000 transactions. And my own forecast is that in the next 10 years, India alone would get about $100 billion of private equity, and China will get even more, but other countries like the Philippines and Indonesia will also benefit with a significant influx of private equity in those markets as well. So if I'm a citizen, what am I getting out of private equity? Private equity is helping me get brand new infrastructure. So private equity in countries like the Philippines, China, India has funded many infrastructure projects like roads, ports, airports. They're even funding hospitals. Private hospitals are funded by private equity. So the first thing that a private equity firm wants to do, or likes to add value in an enterprise, is to improve the quality of its corporate governance. Corporate governance is just another word for running a business in a fair and honest manner. It's about caring about your stakeholders. It's about treating your shareholders equally. It's about treating your customers well. They like to benchmark an enterprise in which they invest to the best in the market. And then after having benchmarked it, they try to improve its operations. They help that process by bringing in what they call operating partners. They bring in well-experienced operating partners who try to improve the quality of the enterprise to the best in the industry. Private equity plays a role in M&A by two methods. There are a number of entrepreneurs in the world that are quite willing to sell control to private equity firms. So this is a buyout. In this situation, the private equity fund, either acting on its own or in partnership with some other funds, takes control, majority control or operating control of the enterprise. The second is when two entrepreneurs agree to do a mergers and acquisitions transaction. And let's assume that the smaller entrepreneur is going to buy a bigger enterprise. So naturally, he doesn't have the funds to be able to buy a bigger enterprise. In this case, the smaller entrepreneur can go to a private equity fund, which has what is called dry powder, i.e. funds that are at its control, which can work together with the entrepreneur, and in combination, they can buy out a much larger firm. An example of such a transaction was in India, where a firm called iGate acquired another company called Patni Computers, which was 4 times its size. Broadly, you can classify entrepreneurs into two categories. One that are much more hospitable to the entry of private equity into their firms, and the others who sometimes do attract private equity, but then don't know how to deal with private equity firms. And that creates a problem. The beginning of a transaction to the end of a transaction is what we cover in our training. So we could start with how private equity funds are created. We start with definitions of the different types of private equity. We then say, well, how private equity funds are created, who the investors are, which are called limited partners, what motivates the limited partners, how they select a fund manager, which is called a general partner, how the fund operates, i.e. how it selects investments, its investment criteria. We also explain how a private equity fund adds value to an enterprise, and even before it gets into the enterprise, how it values the enterprise. So we have a section in our training on valuation of target companies, then how value is added, but even before value is added, how due diligence is performed. That's a very important thing. From there, we move on to value addition in the enterprise, and then we move on to the final stage, which is the exit by the private equity fund. From my standpoint, the outlook for private equity in emerging markets is very bright. The emerging markets are implementing policies of reforms. They are trying their very best to accelerate the development of their countries. However, what these countries should avoid are flip-flops in policies. What that means is that you start off with a certain tax rate or a certain tax regime, and 2 years later you reverse the tax regime. That really hurts the investor. So whichever tax regime a country wants, it should implement it and keep it stable. The bulk of private equity in emerging markets comes from the West. It comes from countries like the United States, England. It also comes to some degree from Japan, but mostly it comes from the Western world. What these countries need to do, the emerging markets, particularly countries like India, China, Philippines, Indonesia, etc., what they need to do is develop domestic sources of private equity, which I think is, if I look into the future, 10 years from today, if we can see a quadrupling of domestic capital moving into domestic private equity, I think that would be the nicest thing that can happen.